Jerome Powell had been rumored to be the pick. What does his announcement or his confirmation, I suppose, when it does happen, mean for the EM debt world?
I think it's going to be positive. It provides a backstop in terms of global monetary policies to emerging markets. Not that Mr. Taylor is not a great economist, but the fear was that he was going to be a bit too hawkish and that perhaps rates were going to go up. And if that happens on impact, that is not good for emerging markets.
Why are you making the assumption that he won't be? Why are you making the assumption that it will be a continuation?
Well, in terms of Mr. Taylor, you mean?
Yes.
Well, I mean, it's if you follow his formula, the monetary policy in the U.S. should be a bit more tighter than what it is now in Europe as well. And he likes rules rather than discretion, which is something that perhaps markets have forgotten about.
How much has the relationship between U.S. monetary policy and the performance of EM financial assets changed over the years? We know that in the past, they were much more dependent on dollar funding for their financial needs, and therefore the cost of dollars had a bigger impact. Has that diminished somewhat?
It has in some sense. I mean, these countries now actually issue a lot more domestic debt denominated in their own currencies. But, monetary policy in the U.S. affects everything, right? So most of the debt that we trade in credit, be it corporate or public debt issued by sovereigns or quasi-sovereigns, is denominated in dollars. They get affected by what happens to rates in the U.S. because of the duration component of it, right? And when it comes to rates, rates actually going up 30, 50 basis points affect, the term premium in the long end, not only in the U.S., but also in emerging markets. And you have seen a sell-off in rates and a sell-off in effects because of what has been happening between dollar, euro, and also what happened, to U.S. Treasuries in the past month.
But the flows into EM have been so strong. So I kind of go back to the point I was making. Do you just assume that terminal rates here are going to be that much lower than previous cycles, that we don't have to worry about emerging markets if what the Fed is anticipating here for rate rises going forward is what actually is achieved?
Well, I mean, there are two impacts in economics, right? I mean, I'm an economist by education, and you have a price effect and you have an income effect.
Yes.
The price effect happens on impact, right? So you have rates going up, and credit markets will suffer, rates might suffer, effects might weaken. On the longer term, the income effect picks up, and if this is happening because the U.S. is growing faster or the world economy is growing faster, then emerging markets are going to perform, no question about it.